All right. Well, I just make sure I'm on mute. Good. So chapter 8, walk through some examples from the various exercises, application exercises for chapter 8 in the workbook. So we'll start with question number 2 on page 303 if you want to follow along in the workbook. So this chapter is all about investing in organizations, bonds, or equity. And depending on how much of the company that you're purchasing, on how you should treat it accordingly. So question 2 starts with a company that paid $200,000 to purchase a portfolio of debt investments, being bonds, on March 1st, and our plans are to hold them for less than 1 year. So under, what kind of accounting method should we consider for this investment? This is a short-term investment. It's a debt investment because we bought the debt of that company, and therefore it should be considered as a short term because we're going to hold for less than a year, and it'll be accounted for by the fair value through net income method. So the initial journal entry then on March 1st of 2020 would be a debit to the short-term investment in bonds for that company of $200,000 and a credit for cash. It's being held for less than a year. So the next part says, what if on March 15th we received interest of $1,000 for the debt investments? And we're asked to prepare the journal entry. So it's as simple as doing a debit to cash for the $1,000 received and recording the interest revenue accordingly for the $1,000. We're asked then, or we're told, sorry, the fair value of the portfolio at the end of the year, March 31st, 2020 was $208,000, and we're asked to prepare the journal entry to record the fair value adjustment. So in this case, the bond has increased in value. So we need to debit an asset account called valuation allowance for fair value adjustment for $8,000. And we need to credit the unrealized gain on fair value adjustment for $8,000 being a other income account. On April 20, 2020, we sold half the investments for $110,000. So we need to prepare the journal entry to record the sales. So this one has a couple of purposes, or a couple of pieces, sorry, where we need to debit cash for how much cash was received, being $110,000. And then on the credit side, we need to look at the original bond investment. So the original bond in Part B was worth $200,000. So we need to credit for half of that, being $100,000 for the short-term investment bonds, and then record the sale accordingly. So then we have a credit to gain on sale of investment for $10,000. All right, let's move on to question 3. Question 3 says, Feng is planning on purchasing $250,000 worth of 6-year bonds issued at par by George Company, privately traded company, on January 1st, 2020. Interest rate is 3%. Payments are made semi-annually, so twice a year on June and December at the end of those 2 months. And Feng has a December 31st year end. So you'll see, first of all, we actually purchased at the beginning of the year and we held it for the full year. Doesn't usually happen, but it's a nice example to start with. So the first part of the question says, if their investment goal is to hold the bonds until maturity, what valuation method should they be used to record them? Because they're planning to hold a maturity, the amortized cost method should be used. These are 6-year bonds. And because they're 6 years, they would be classified as a long-term asset. So our journal entry to set up the original investment would be a debit to long-term investment for bonds and a credit to cash for the $250,000. So we're asked to record the first interest payment. So it's semi-annually. So we take the 3% annual interest rate times the $250,000 in par value for $7,500. It's a semi-annual payment, so we'll divide that by 2 to take 6 out of 12 months. So the cash expected to be received on June 30th would be a debit of $3,750 and a credit to interest revenue for $3,750. So let's skip forward to 2026. We're asked to create the journal entry for the retirement of bonds 6 years later, being January 1st, 2026. So that time, it's as simple as debiting cash for $250,000 and crediting long-term investment for bonds for $250,000. So you can see how it goes in at the beginning of time in 2020 and comes out in 2026. All right, so let's skip down to question 6. We have a company called Midland. Their investment activities from 20 and 21 are itemized below. Our year end is December 31st, and we report our investments according to ASPE. So on January 21st, 2020, Midland Company purchased 200 common shares of Marksman Holding on the TSE for $18.92 each, and it represents a very small percentage of the outstanding shares, and we plan to keep them more than 1 year. So let's go to the journal entry for that transaction on January 21st. We plan to hold them for more than a year, so they would be a long-term investment asset in shares, so debit for the value of $18.92 times 200 shares, or $3,784. And then our cash would be credited accordingly. June 30th, we received dividends from Marksman Holding for $1.50 per share. So June 30th, our cash received, $1.50 times the 200 shares, would be a debit of $300, and we would credit our dividend revenue account for $300. On December 31st, 2020, the trading price of those shares went up to $19. So to record the unrealized gain, we take the $19 market value less the $18.92 that we recorded those investments at. So they've increased by 8 cents per share times the 200 shares. Our valuation allowance for fair value adjustment would be debited for $16, and our unrealized gain for fair value adjustment would be credited for $16. And then skip forward to January 28th, 2021. Midland Company sold all of the shares at $19.23 per share. So the cash received would be $19.23 times the 200 shares, or $3,846 as a debit to cash, being we're receiving the cash. And then we need to clean up the asset accounts. So we have the long-term investment in shares at $3,784. So we will credit that, removes those investments. We need to credit the valuation allowance to get rid of the $16 markup that we did as of December 31st. And then the difference being a credit amount of $46 is an additional gain on sale of investment. If for some reason that difference was an additional debit, then it would be a loss on sale of investment, which is not the case for the question 6. Let's move down to question 8. We have a company, Raj. They had the following activities in relation to its investments in 2020, and the company has a June 30th year end. On January 1st, Raj purchased 25 common shares from Terry Company for $960,000. So let's skip forward to that journal entry as of that point in time. And long-term investments are shares, prepare the journal entries assuming no significant influence is not achieved. So we've got part A is no significant influence versus part B is significant influence. So just keep that in mind as we go. So January 1st, our initial purchase, Raj, Vi, and Terry. The plan is to keep them long-term as per the statement here. So we would debit long-term investment in shares for $960,000 and credit cash for $960,000, and that works out to be $38.40 per share, which we just need to note for future purposes. In this case, because we are not having significant influence, we do not record our share of the net profit as of March 31st. But on April 30th, we received cash dividends of $1.10 per share. So our $1.10 times 25,000 shares would be a debit to cash at $27,500 and a credit to dividend revenue of $27,500. And that's to record the cash dividend. Look at the transaction for June 30th under no significant influence. The shares were being traded at $39.20 per share, so we have a valuation adjustment to make. And actually, there's a typo here, but and I can't fix it unfortunately. But $39.20 less the $38.40 is 80 cents times 25,000 shares is the $20,000. So it's just a typo here. It's not an error in the journal entry. So it's a debit to the valuation allowance on fair value adjustment, being an asset account, $20,000. And a credit to the unrealized gain on fair value adjustment being an other income account. Now, let's go through the same situation, assuming that we have significant influence that represent 25%. of the outstanding shares. So the original investment is very similar, except in this case, it's called investment in Terry Company shares. Okay, for 960, still an asset. Cash, 960, and that's to record the acquisition at 3840. Now on March 30th, when we received the statement saying that they have net income of $386,000, because we have a significant share, we need to record our percentage of that net income being 25%. So on March 30th then, we scroll down a little bit here, we have the investment in Terry Company shares would be debited. So the value of them would go up by 25% of the net income being $96,500. And we would credit a other revenue account from the investment in Terry Company for the same. Now the dividends, instead of being a credit to dividend revenue, because we've already recorded our share of revenue, and dividends come out of any retained earnings, which is affected by any net income, we need to debit our cash that's being received as those dividends of $27,500. And we need to reduce or credit the investment in Terry Company shares by how much was pulled out of the company. Okay, and that's it for this point in time. All right, let's skip down to question 10. Actually, I'll zoom in this time if I can. There we go. So question 10 is on June 1st, Put Company acquired 5% of the 800,000 common shares of SEMA Company, paid $3.5 million in cash. SEMA paid cash dividends of 68 cents per share on July 30th, 2020. And at Put Company's year end on December 31st, 2020, the market value was $90 per share. And for the year ended December 31st, Put Company has income from operations of $1 million. And so we're asked to create the partial income statement, basically the bottom section of the income statement for Put Company for the year ended December 31st. That starts with the income from operations. And we're assuming a 30% tax rate. So income from operations would be the $1 million we're told up above. Our other income and expense section then would have a couple of components. One being our dividend revenue, which are the 800,000 common shares times 5%. So the total number of shares we purchased were only 40,000 shares, times the dividend amount of 68 cents per share. So the dividend revenue recorded for this year, assuming that's our only investment, would be $27,200. Our unrealized gain on fair value adjustment then would be the 40,000 shares that we acquired, times the difference between the market value and the purchase price. So we take the $90 and the $87.50 that we paid per share initially would give us an unrealized gain on fair value adjustment of $100,000. So our other income, if that's all we have, is $127,200. So our income before income taxes would be $1,127,200. Take a 30% income tax amount of $338,160. Our net income, assuming no other edits for Put Company for the year ended December 31st, 2020, would be $789 and $40. All right, let's take a look at question 13 then. And question 13 says Zhao Company, a private company, acquired 210,000 of the 600,000 shares from Zahara Company for a total of 1.68 million. And this investment is part of their long-term business diversification plan. Their company's year end is December 31st, and it chooses to use the equity method of accounting for strategic investments. And we're told that during the year, Zahara Company recorded an annual net income of 908,000, and they paid a cash dividend of 300,000. So we're asked to prepare the journal entry to record the acquisition, the journal entry to record revenue of investment, and the journal entry to record the receipt of cash dividends. So in this case, the original acquisition was for 1.68 million. So we would debit our investment in Zahara Company shares and credit cash for the same amount. And that's for the 210,000 shares. June 30th, the investment in Zahara Company shares, we need to record our share of the net income for that company. So the net income was 908,000. We purchased 210 of the 600,000 shares. Okay, so we're 35%. So 35% of the 908,000 would be an amount of $317,800. So we would debit to increase the value of our investment in Zahra Company shares and credit revenue from investment in Zahra Company being an other income account. When the dividends are paid then, we take again our percentage of the common shares being 210 out of 600 or the 35% times the amount of dividends paid, which was 300,000. So the amount of cash we would receive from that transaction on July 30th would be 105,000 debit to cash and a credit to reduce our investment in Zahra Company shares because the equity of that organization is declining. Now the next part says, how would the accounting for the above transactions differ if they were a publicly traded company? Because up above, it said they were a private company. So if they're a public company, IFRS would also require the use of the equity method to account for the investment in Zahra above. However, they already chose to use the equity method, and therefore there would be no difference in the journal entries. Now, ASPE, being a private company that they are, would allow the cost method in which ownership is between 20 and 50, and they are below 50, they're at 35%. So because they're a private company, they could have chosen either, but in this case, they chose equity. And that's the examples. Reach out if you have any other questions.